Stock investors are faced lately with splitting their attention between the Democratic primaries, the impact of the coronavirus, and the Q4 earnings season, which, although still underway, is nearing an end. Our chief equity strategist and economist John Blank tells us now which of these pose the greatest risk to the market. John, there's definitely a lot going on here. Is there just one of these that's pressuring global markets, or is it a combination of all?
Yeah, I think you should keep your eyes on the coronavirus because that's going to be a quarantine effect that can play out in March and April. So near term, I think the coronavirus far exceeds the other two. The presidential election, we don't know for sure who the Democratic nominee will be until July. So that one's certainly more of a summer run. And then the earnings story, right now, we're having a pretty good earnings season. If we get through the remaining companies, we have about 77% of companies in right now. We're getting a 0.9% growth rate for the quarter, which actually is higher than it was expected. It was actually expected to be negative. So it's not very strong. It's not going to move the market, but at least it's better than people thought.
But investors, on the one hand, seem torn between the outlook for the coronavirus weighing on global economic growth and then the optimism over the latest batch of global economic indicators showing rebounding global growth. So how can investors handle the quandary?
Well, the question you have to ask yourself with the coronavirus is all of this growth that's being lost right now get backloaded into the rest of the year? So the question here really is, does the contagion leave China and affect Japan and Singapore and then spread from there? Or does it get contained and actually create some stir-crazy Chinese, and then they go nuts traveling and moving their economy up in the second half of the year?
What do you see actually determining the effect of this coronavirus on not only China's, but the global economy?
Well, here's where we're going to have to watch Singapore and Japan. It's really, those are the countries that have the most air travel and interaction economically with China in that region, and we know those are the coronavirus hotspots outside of China, not anywhere near like China, but that's where we got to watch for the crisis to spread. So this is where, we got to keep our eyes on Singapore and Japan.
Will the global GDP growth be cut?
It already has been cut. I think, usually it's about 3.5% for the IMF estimates. I would expect to go to 3% because a lot of it's, 50% of growth in the world economy is China. So there's no question that will feed through to the global growth estimates at this point.
What major disruption to the breadth and length of the supply chain do you see coming from this?
Well, here's an interesting point of view. I mean, a lot of companies in the United States use Chinese supply chains and have done so for 20, 25 years, and they're very dependent upon them. So this may be an event which they cut and run and start to develop supply chains in places like Vietnam or even down in Honduras and Mexico and other parts of the world where they can say, hey, you know what, Indonesia looks a lot better to us. So what you might see out of this is, if it keeps going beyond April, is that some of these major suppliers start to make more long-term moves into these other countries.
Q4 earnings season we talked about just briefly. Let's take a look at that a little deeper. It's wrapping up here soon. The holiday season profits came in better than expected. Does that mean that this earnings recession is over?
It might be, Terry. That's a kind of an interesting statement that you just made, and it just might be. It's probably, unfortunately, because of the coronavirus, we're going to get a negative growth rate in earnings for the first quarter of this year. But it may well be that the fourth quarter of last year does see a positive pop in earnings, and that would be the end of this growth recession. But it's not so strong that it's making any difference. I mean, if we get a 2 or 3% earnings growth that's positive out of the first or second quarter this year, that's still not enough to support stocks that are now trading at almost 19 times earnings. So the bottom line with the market trading 19 times earnings is absolutely every piece of good news is priced in, and even this small amount of good news is not going to help at all. It can only hurt.
Have the eurozone banks turned the corner now, thanks to strong performances by the Wall Street banks and Spanish lender Santander?
Yeah, there's some evidence that they are finding a way to do pretty well in the QE environment. I think a lot of what's going on there is you're seeing the European Central Bank start to warehouse a lot of loans and bonds out of the banking system there. And they're basically providing way more liquidity into the banking system than you might expect from the U.S. perspective. And that is seeming to give some type of spread between basically free money from the ECB and their lending operations. And we are seeing that it's profitable for them to do this. I mean, I don't think it takes a genius to figure out if someone gives you free money, you're a bank, you can make some money at it. So it shouldn't be surprising, but we're seeing it.
Can we infer then that Europe's economy might have reached a turning point?
Oh, no. Europe's economy is heavily dependent on Germany, and Germany is heavily dependent on China. So there's no question that the weak man in the global system is still Europe. And it's, again, one of these situations because of the liquidity drivers in China, in Europe, and the United States. The financial markets can go an entirely different direction than the economies. But the economy of Europe is not strong, and I still do not see any meaningful uptick from more than a 1% growth rate for 2019, 2020.
And we have a variety of global central banks meeting, either have met or are going to be meeting soon. Anything standing out to you there?
Only that we're getting more easing, which means they aren't seeing the growth, Terry. And, this is the paradox of the modern global system and why so much deficit spending is getting done and it's not creating any backwash is because there's simply no growth in the global system. And it used to be there's some growth in China, 5 or 6% a year, but now that's gone. And literally in the other major regions of the developed world, I do not see anything more a 1+ growth rate anywhere, including the United States. So this is not good. Japan is in recession. Europe, Germany is basically in a recession or very close to it. United States, 1.5% to 2% growth rates for 2020. Really not a good picture from the economic factors, but I want to tell everybody not to read into the stock markets from that because the stock markets are awash in the liquidity. That's what you're seeing in the global central banks. They're just printing money and keeping rates low, and that's making stocks the only game in town to make any return. So it's holding stocks up, and this is going to be one of those bad news is good news. So as soon as we get some global growth and there starts to be less liquidity, we can see this bubble pop.
Speaking of stocks, now you're considering as top picks Microsoft, J.P. Morgan Chase, and Pfizer.
Yeah, let's talk J.P. Morgan Chase first off. That's the Zacks number 2 ranked stock. However, the C for value and an F for growth. This stock, man, I mean, it's tough to imagine how it can get any better. One thing to note, though, it does have a 2.6% dividend in this environment. If you're going to buy a bank, this is the one to buy. And it's $136 a share. I don't know if there's much more upside, but at least there's not as much downside and you get that dividend. Pfizer is a B for value and an F for growth again. So in these big names, you're just not seeing the growth. This stock, though, pays a 4.2% dividend. So from just owning it for the dividend, this is a great stock to know. $37 a share with a 4% dividend. The final one is Microsoft. Microsoft has just gone crazy as a stock the last year or two. I have it at $186 a share. What you need to understand about that, it's a forward PE ratio of almost 33 and a value score in our system of D. So, and by the way, the dividend here, since it's tech stock, even the big one, is only 1%, 1.1%. So here's a stock that you have to watch for. It's starting to taper and move sideways. If this type of stock goes down, given its market cap, the market cap of this is $1.4 trillion at that 186 a share. So this thing can go 20% down and take a big chunk out of the market. So the way the market correction happens, it comes to play with a stock like Microsoft.
All right, that's the latest with our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo, and don't forget you can get advance notice of positive earnings surprises because Zacks Research Breakthrough Now is predicting with about 80% precision which stocks are going to be beating earnings expectations before their reports are even released. In order to find out what stocks are coming through the screen, just visit zacks.com/promo, where you can get all the details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.